Good morning and welcome to this Monday, September 12th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, first thing I'll say about this week is it is option expiration week, what I like to call opposite George week. That's a Seinfeld reference. But usually whatever is working in the stock market, a lot of times all of a sudden doesn't work, and the things that aren't working tend to work. So that would be the first thing I would kind of keep in mind as we move throughout this week, is that a lot of times we can get some whipsaw action, a little back and forth. In the big picture, it doesn't mean a whole lot, but in the short term, it means a lot to traders, especially those who are trading options. So you can see it's really important if you're in options, short-term options, and you're in a stock that maybe has made a big move, you've got a pretty nice gain. Holding into option expiration Friday can be painful at times. Sometimes you get those big reversals. So just be cautious, be aware of that. We've got a couple huge inflation reports coming out this week. The August CPI will be out tomorrow, Tuesday, September 13th. And then on Wednesday, September 14th, we'll get the August PPI. And of course, the Fed is looking at this pretty closely. I was looking at estimates. Actually, I'll go through those estimates with you in just a couple minutes. But for those of you who are new to Earnings Beats, I'm going to start off, as I always do, with our website, just so that you know where to go. We do have a free newsletter. So if you go over to earningsbeats.com and then you scroll down, you will find an area where you can sign up for our free newsletter. It's a 3 times a week newsletter, Mondays, Wednesdays, Fridays, usually published by about 8:30, quarter to 9. Usually gives you some time to check it out before the opening bell. It's a very, very quick read, just a couple of paragraphs and a chart typically. And it focuses on the things that are really important to us, things like earnings gaps, relative strength, those sorts of things. There's no credit card required. You can unsubscribe at any time. So if you haven't already, go over to Earnings Beats, make sure you sign up for that newsletter. It's a great way to learn a little bit more about how we approach the market, and maybe it can help in your trading. All right, let's talk a little bit about what happened on Friday to close out the week. It was a pretty strong day, and we had a nice rally going. Early last week, and maybe even in the week before, I was talking a lot about how the market was getting very, very pessimistic again. Options, if you looked at the 5-day moving average of the equity only put call ratio, it had moved back above 0.80, or I think it was just above 0.80. I think the last time back in mid-June, we got to the 0.82 level, and that was one of the things that encouraged me basically to declare a bottom back in mid-June, was the sentiment and the strong bearish sentiment. And we had that again last week. I know, I think I wrote an article, might have been, actually, I think it was in the Don't Ignore This Chart blog. But if you go in and check that out, there was an article I wrote, I don't know, maybe Tuesday of last week, something like that, where I was saying that this chart many times will give us tradable bottoms. And I pointed out that 0.80 level on the 5-day moving average. And sure enough, this is where the rally's begun again. I mean, I don't make this stuff up. I've done a lot of research, studied these levels. And when you get to a 0.80 level, that's pretty significant 5-day moving average. It's telling you a lot more puts are being traded than normal. So a lot more option traders are getting very bearish. When everybody starts going into one side of the trade and things start tilting in one direction, that's when we usually have reversals. That's how market makers make their money. So we got the big reversal. Dow Jones Industrial Average up 377 points on Friday, back up to test the moving averages. S&P cleared it. One thing this tells me, when I start seeing moving averages lost and then regained and then lost and then regained, is it's telling me we're more in a sideways consolidation type of an environment rather than a downtrending environment. That's pretty important. When you get back up through these moving averages, it's not I personally don't treat it as a mistake. I mean, to me, this is a very significant development technically when you're able to get back up above moving averages, because it starts painting more of a picture of sideways action, rectangle, if you're thinking about like a rectangular chart or pattern, that's what I would be looking for. And so you look at the recent high on the Dow and the recent low, and that could be a range for a period of time. It might be some intermediate highs. It could have been, if you remember this big red candle, that's when Fed Chief Powell was giving his speech from Jackson Hole and talked about more pain ahead. Well, that level might be somewhat significant. Maybe we go up to that level and then pause. Very difficult to say. Anyway, I just think it's important when we start going through these key moving averages, just to mention, to me, it's a little less like a downtrend and a little bit more like sideways or rectangular consolidation. Anyway, the S&P was up 61 points, 1.5% on Friday. NASDAQ up 250 points, more than 2% on Friday, to also close back up above both the 50 and 20-day moving averages, barely above the 20, but hey, above is better than below. Mid caps, nice day, up 1.78%. Small caps, 1.91%. Very, very strong action, both of those indices as well. And then all 11 sectors were higher on Friday, led by communication services, and they are starting to move right where they needed to. They had gone down to that June low and bounced, now back up through the 20-day. That's encouraging. See if it can continue. Energy had a strong day, up 2.5%. Technology 2%, discretionary 1.9%, materials 1.5%. So really good, solid day last week to close out the week, and a nice week overall, especially given where, how bearish everyone had gotten in terms of the equity only put call ratio. So pretty good action there. 10-year treasury yield. By the way, there are no economic reports of significance that I'm aware of for today. So it's all eyes on tomorrow morning and Wednesday morning. The August CPI is expected to come in. Headline numbers is expected to go down by 0.1%. Last month it was flat. The August core CPI, and again, CPI will be out tomorrow morning, Tuesday morning. August core CPI expected to rise 0.3%. Last month, it rose 0.3%. 0.3% times 12 is 3.6%. So that's a far cry from the 6, 7, 8%, annualized rate that we've seen on the CPI and the PPI. Anyhow, we'll see how the numbers come in. If they come in below that, we could be set for a bigger rally. I mean, if this whole selling has been because of higher interest rates and inflation talk out of the Fed, well, if we get a lower than expected number, you would think that would just simply add to the recent move to the upside in the market. We'll see. August PPI on Wednesday expected to come in at minus 0.1%. Last month, remember that headline number was minus 0.5% because of the huge drop in crude oil. I don't see that kind of a drop coming. I don't really have a feel for where these numbers might come in. I'm guessing, I would guess the August PPI number, the headline number, might come in around the flat line. And then August core PPI expected to rise 0.3%. Last month was 0.2. So I suspect we're going to be somewhere around there. I don't think it's going to be a shocker either way, but I don't know. We're going to find out together the next couple of days. But looking at the 10-year treasury yield, currently, I am showing it down. Well, let's get an update here. Yeah, 3.28, 3.29%. So down a little bit more than 3 basis points. If the move back up in interest rates caused the S&P 500 to drop, then it certainly seems practical, I guess, to think that if we pull back or continue to pull back in the 10-year treasury yield, that certainly would help to lift equities. We'll see again as we go throughout the week. Tomorrow, the next 2 days is going to be big for the 10-year treasury yield. You'll get potentially a big reaction in the bond market from inflation reports. So if the stock market's been going opposite bond market, then you're going to want to keep an eye on the bond market and how that reacts to these two inflationary reports as well. Right now, we are showing futures up this morning, by the way. Dow futures up about 0.25%. S&P futures are up about four, well, about 18.5 points. That's easier. It's between 4 and 0.5%. And NASDAQ futures right now up about 0.4%. So where that was as of about 10 minutes ago. So that's where we stand going into today. Looking at the S&P 500 chart. That's what I was talking about at the open. 3 really nice days to close out last week, moving right back up above the moving averages. And if we get tame inflation reports, we could see this continue right back up to 4,200. I think the first key area of resistance for me is going to be around 4,100 to this breakdown right here, which was at 41.28. So I'm going to say 4,100 to 41.28. If we get back through that, I think we're going back to 4,200, which would be right about where we were when the Fed Chief Powell gave a speech. And that's where we had that huge down day. This was all distribution. This was a trend day in the wrong direction. And really, if you look back over the last few months, it was really the only horrible day. I guess, maybe this one back on June 28th, a little rough. Here was a day, July 18th. But I mean, that was by far the worst day. And it looked a lot like some of these other days from earlier in the year. So it was worth paying attention to. When you lose a key moving average like the 20-day with that kind of a candlestick, got to be at least aware of it and recognize the resistance as you go back up. First key resistance was the 20-day moving average. We took that out. That was a good thing. So a good technical day on Friday, coming up and clearing both those moving averages. Very, very strong. The NASDAQ 100, which I also like to look at, not quite above its 20-day. It did clear its 50-day, but its 50 and 20 are almost exactly. You can come over here and see the numbers. The 50-day is at 12,578. The 20-day is at 12,594. Now I use 50-day simple moving average, 20-day exponential moving average. And I know that's a little odd. I'm a little odd, but that's for me, from a common sense perspective, that makes more sense to me. For a short-term moving average, I want exponential because you're focused on the short term. So treating the more recent days more heavily makes sense in a short-term moving average to me. But to move out to the 50-day or especially the 200-day and then start using an exponential moving average on it where you have more weighting toward the more recent days, that's the reason why I don't do that. I like it as a simple moving average. Everyone's different. Some like both simple moving averages, some like both exponential. I like to split them. But that's just my own personal choice. Let's see, what else do we have? So with the NASDAQ 100, we did hold on at 12,000. That was pretty important. Now we're back up above 12,500, trying to get through these moving averages. If we can do that today and close there on the NASDAQ 100, that would be at least a short-term technical positive. Of course, again, next 2 days, big inflation reports. So we might be able to throw the technicals right out the window, depending on how these reports come out. I don't think it's going to change much for the Fed, at least in terms of what they're going to do this month. I think the market is pricing in 75 basis points. Maybe they surprise with only a 50, but I think, they're all talking tough. So I think they're probably going to raise 75, which a month and a half ago, I would have said no way. I did say no way. I continue to be wrong on what they're doing. And I'm not so sure the market isn't more upset at the Fed than they are at actual inflation and interest rates and, the negative GDP. I'm not so sure that some of this recent selling hasn't been more about maybe losing a little confidence in the Fed. So, if the Fed raises, if we get 2 more tame reports the next 2 days and the Fed raises 75, they really need to start talking a little bit more about what they're going to do in the future. You can't say that you're data dependent and then get much more dovish data and then still stay hawkish, because then the market really is going to lose confidence in you. They've said that they're going to be data dependent, but they want to see more than 1 month. So if you see 2 months and then keep raising and keep talking about, at some point your credibility goes out the window. So I think if we get inflation at or below expectations, I think the Fed is going to need to do something in their policy statement to address this, which I think would be bullish for stocks. And again, if they don't, then I think it's going to be bearish for stocks, but it's not going to be because what the Fed is saying. It's just that the Fed is kind of losing credibility. Just my opinion and my take on it. Moving on, let's talk a little bit about relative strength, because relative strength is always important. What leads the market is really important to me. And last week, we saw technology go down again. Even though we rose, the S&P 500 went higher, technology on a relative basis went down. This is the most important sector, in my opinion. I mean, I think consumer discretionary is a close second. But technology and consumer discretionary, these are your two key risk-on sectors. And so you want to see these two groups doing well when the stock market's moving higher. What I would say at a minimum, I want to hold on to this relative support level right here. So again, if you look at this last week, technology did go higher. Remember, up here, I'm talking on a relative basis. I always like to point this out because I get questions from time to time. You know, I didn't understand what you were saying. I look at technology and it went up and you say it's going down. No, I'm saying it went up last week, but it went up less than the S&P 500. So when you chart the XLK $SPX, this is just telling us what the relative strength of technology is doing. And it went down last week. This needs to turn back up. I was really bullish when we saw this June reversal, just shooting straight up. And I talked about how when we've seen that in the past here, we've seen it here. I mean, when you get these from underneath the 20-week and 50-week moving averages and we take off, that is usually a really good thing for the stock market. But look at what happened this time. There's never any guarantees. When I saw this, I was very bullish, didn't expect this. Also didn't expect the Fed to say what it did. We don't need editorializing from the Fed. Again, just my opinion. But anyway, that's where technology looks. Now let's looks at right now anyway on a relative basis. Let's look at consumer discretionary. Discretionary now has moved back up above its 50. It's really making a strong move. This is good. So while technology kind of giving us a little bit of a mixed signal, there's no mixed signal here. Consumer discretionary on a relative basis is taking off and has since back in mid-May. Again, money rotating from May to June. Remember, the S&P went to a new low. Look at what the relative strength of discretionary did, though. It was a higher low. This type of behavior and this type of rotation was also a factor when I called the bottom back in mid-June. It wasn't just sentiment. It wasn't just relative strength and rotation. It's a combination. It's putting, as I've said before, putting a puzzle together. When you start, you know, I know that sentiment can trigger market bottoms. I know rotation can trigger market bottoms. When you get them together, it starts to add up a little bit more evidence toward a bottom. Anyway, so far, really good action here on discretionary. Communication services is another one of the aggressive areas. Look at this one. Really bad. We need internets. We need broadcasting and entertainment. You know, we need the Netflixes of the world. We need the Googles. We need Disney. Those are the kind, you know, Snap. Pinterest, saw a big breakout in Pinterest on Friday. That was good. But it's going to take more of that. This group needs to turn back up. Throughout the secular bull market advance, and I'm going to go from April 13th, April 10th, 2013 to the beginning of January of 2022, before this bear market started, the three groups that led the market higher by a very wide margin. First of all, technology was the clear leader. And then it was discretionary, and then it was communication services. These are the three groups that lead secular bull markets. So if I'm calling a bottom in the cyclical bear market, and I believe that we are resuming the secular bull market, which I do, then what I want to see is leadership from these three sectors that I've just shown you. And right now, quite honestly, the only one that is doing it is discretionary. So if we get whatever these reports are the next couple of days, let's say the market does rebound and start or keeps rebounding, watch these relative strength charts on these three. If they're all turning up and they're all going up with the market, that is a really good sign. If they continue, like the XLC, continue to languish near the bottom or set new bottoms, and if technology goes back down, sets that new bottom below these lows I showed you, that would all be bearish developments for the market. So I'm not saying absolutely we're going higher. I'm just saying, based on the signs, I believe we're going higher. There's a difference. I'm open to another move to the downside, but I've got to see other signals that are telling me that that's going to happen, or that that's more likely to happen. And I'm not seeing that just yet. All right. And maybe I will. Maybe these couple inflation reports coming up. The Fed meets next week. The second half of September, by the way, not good historically. I've talked about September being a bad month. First half of September historically isn't that bad. It's not great, but it's not bad. The second half of September is where the bearishness usually surfaces. And so today is the 12th of September. So by the time the end of the week rolls around, we get into next week, the Fed meets. That's when we tend to see the market at its weakest, in September. That's just historically. It's not a guarantee for this year. It's just telling us that based on history, that one signal would be more bearish than bullish. All right, looking at some of these industry groups, I just wanted to talk about a couple of these. Of course, computer hardware. That's Apple's home. This is part of technology. We talked about technology not doing very well. We just had a 52-week high, relative high. Actually, this is a three-year relative high, all-time high on the computer hardware relative chart versus the S&P 500. So computer hardware is not a problem. You want to see the problem? I can show you the problem right here. Semiconductors. Since we topped in November on a relative basis, going straight down. I mean, even these rallies, here we rallied. We were, a little bit off of the prior low. Well, the relative strength was a little bit closer to that low. We do not want to see semiconductors breaking to another low below that June relative low. This is where we need semiconductors to move. The good news is that because many of these semiconductors have been hit so hard, and I haven't looked yet at Max Payne, but I know Aaron, who put out our Max Payne spreadsheet this weekend for our members, I can tell you that there were some semiconductors that had a lot of in the money put premium, meaning there are a lot of folks out there that are sitting with a pile of money on the put side. So if semiconductors rise this week, a lot of that money goes poof, and market makers get a little windfall. So don't be surprised if these next two reports come out and they're not bad and the market goes up. Look for leadership in semis this week based on Max Payne. This is the group. Remember, opposite George week. Look at what they've been doing going into options. Down. NVIDIA has been horrible. AMD. These are stocks that have been going down a lot recently. So there's a lot of in the money put premium. Those are individual stocks I would not be surprised to see a strong week, especially if the market overall goes higher. I would look for leadership there. Software. Software's been doing a little, well, it had been doing a little bit better, but you can see this is another group that's come down. Looks very much like the technology chart, except software is below this prior low. I think in technology, yeah, it was higher. If you go back to the May 21 low, see how these lows are higher on technology. And then here's the May low on software. Software has actually been weighing down technology, just like semiconductors. So these are two groups that need to get going. If they don't, I mean, if software can't outperform the S&P, semiconductors can't outperform the S&P, and technology as a whole cannot outperform the S&P. I'm not saying the S&P can't go higher. It's just that it's not getting the leadership to really make that move sustainable over the long term. So we'll keep an eye on that. All right. Looking at some earnings, upcoming earnings. There's not a lot of upcoming earnings this week, but I wanted to just point out a couple. One is Oracle, and I believe they report today. I think it's after the bell today. But Oracle, you can see on the chart here, and I pulled it up on a relative chart. Relative to software, it's actually been a pretty solid stock because software has been going down. Yes, Oracle's been going down, but it's been going down less than the group. So as a result, just recently, it was near a 52-week relative high. Is that going to translate into a good report? I don't know, but if I was, if I'm a fan of software, I want the stocks with relative strength reporting. I think that's what Wall Street, they're moving into those stocks. So I would feel better going into the earnings reports holding a stock like Oracle versus some of the other software stocks that have been killed the past couple of months with their earnings reports. I believe we're going to see a decent report out of Oracle. We'll see. And one other company I'll talk about just for a second is Adobe, another software company. They report on Thursday. I believe it's Thursday this week. And if you go down here, look at the relative strength of Adobe, much closer to its 52-week low. So if we just look at these two companies and you asked me to tell you a Wall Street story about these two companies, I'm going to tell you, based on what I'm seeing, Wall Street likes Oracle and Wall Street doesn't like Adobe on a relative basis. Now, that doesn't mean Oracle is going to go soaring after they report earnings and Adobe is going to go cratering. But you've got to wonder when Wall Street goes in and talks to both management teams and we're not seeing the money rotating into Adobe the way we are into Oracle. That's why personally, I think relative strength is so important because it tells me that story. I don't have to listen to an analyst. This is all the known information in the market. That's the beauty of technical analysis and relative strength. Everything that's out there that's known is built into price. I mean, analysts, these Wall Street firms, they're looking ahead. They're talking to companies' management. They see where the opportunities are, and they make their choices. Relative strength is the result of their choices. So, again, I like Oracle coming up more than I do Adobe. I like both companies long term. I think they're both great companies. I'm just talking about the short term, what they're going to have to say this week. We'll see what happens there. All right, let's wrap this up with the three you must see. So I thought what we'd do here is just take a look maybe at the 3% up, big gainers from last Friday. So we're going to take a look at Dish, Kroger. Kroger reported pretty nice results last week. That was the reason they had such a strong day. And then Take Two. So let's go ahead and pull those up. First is Dish. AD line trying to strengthen a little bit, but it's been down. Stocks really gotten killed. I mean, I'm seeing a bear flag. Really got to get through about 20 and a half before I'm going to start thinking anything bullish here. This is a stock relative to the broadcasting and entertainment group. It's down near its 52-week low. And so is the group relative to the S&P. So you got a not so great stock in a not good industry group. I'm not interested, even with that big move up the last 3 days. This could be, some of this could be relating to options. I don't know. It's a little early to see that kind of a move based on options, but maybe we get a little bit more strength. But I would really need to see more relative strength. I'd need to see some key resistance levels taken out. And I just don't think we're there yet with Dish. Kroger, it is a more defensive group. Obviously, it's in the food retail and wholesale space. But there was that big move right there with earnings breaking out above prior highs. I think that it's a decent stock relative to its group. It's been outperforming now for the last 6-7 weeks or so. We'll see whether or not we can continue that. But I do like the breakout. I would say, $49 to $50 down in that area is a good entry into Kroger if you're looking for something that's more defensive oriented. Last one I'll go over, and then we'll wrap this up. Take-Two Interactive. We did get the big move on Friday, but another one that really has struggled. We got to get back through that 137 area. To the downside, 115 to 120 has been great support. So if we're down in that area and you like the stock, that's not a bad area to get in. But again, look at Take-Two. It's an okay stock in an absolutely horrible industry group. I don't know if I've seen internet underperform this long and this poor and act this poorly. And obviously a lot of it has to do with interest rates. So I do think that if I'm right and the Fed does at some point pivot, I believe this is going to be a group that's going to accelerate very quickly back to the upside. But I like the momentum. I like to see the momentum first. We're not seeing that yet in the internet stocks. And as a result, I probably would do nothing with Take-Two at this point. All right, let's see what the market's doing. Got the Dow up 141, S&P up 28, NASDAQ up 88. So we are continuing to move to the upside. What I said last week to our members, because I was in the leveraged ETF, QLD, for a while, but I got out of it. The reason I got out of it is, number one, it's option expiration week. We're starting to make a move. I just not really comfortable in a leveraged ETF. But the more important thing is these two inflation reports next 2 days. I like to get into leveraged ETFs when I really feel comfortable, coming off a key support level or making a big breakout and just having everything lining up. Right now, technology, that's a big part of the QLD, and it went down last week relative to the S&P. So, the signs aren't great to be in leverage right now. Not that, again, I think we're going higher, but I just don't think doing it with leverage right now, investing with leverage is the best way to go. That's just, again, my opinion. I really try to pick my spots with leverage, but I'm still comfortable on the long side, especially after closing above moving averages last week. I think today will likely be a good day. Will we get sellers this afternoon before that report tomorrow morning? Maybe watch for that. But otherwise, I expect we're going to have a pretty decent start to the week. We'll see. Anyway, that's it for me. Listen, everybody have a great week. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. It'll be the recorded version, but all you have to do at 9:00 Eastern is go over and click on Stock Charts TV, and the show will come up. Anyway, everybody have a great day. Happy trading.